Good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we start off this week also on a somewhat weaker foot with regards to the major equity indices. However, I will say the price action here from yesterday was somewhat encouraging because when we started off the week, one of the major things that we noticed at the end of last week was the rejection here at 57.75. That was a major resistance level that the bulls really needed to get back above in order to just get us back to neutral. But we clearly were rejected off of that level and started trading lower. As of Friday, we were looking like there was a much bigger probability of a larger pullback here all the way down to 5,100, which is the next major support level here to the downside if we did break below 5,500 here on subsequent moves. But, yesterday's price action, I would say, was somewhat encouraging at that, the 5,500 level. We effectively opened up at that level and managed to trade back above it on some decent volume. So the question is really, have bulls managed to muster enough to basically hold 5,500 and maybe get back into a bit of a slightly bearish but still neutral state of the market and potentially make another crack at 57.50 and break out here? Or do we kind of find ourselves in a bit of a consolidation range and then finally break down here to the downside? It's hard to say right now. However, at the moment, it's hard to say, especially with tariffs on the minds of every investor here for Wednesday, which is when a fairly comprehensive set of, call it, reciprocal tariffs are meant to go into place. The question is really, what does that look like here uh, on Wednesday? I will say that any surprises in that reciprocal tariff has the potential for markets to interpret it as positive, interpret it as not as onerous, as kind of a flat 25% across the board for all countries. And that certainly could be the catalyst that drives the markets higher from here. So, the fact that we held 5,500 and we have this kind of major event coming up tomorrow, we certainly have a catalyst that could potentially drive markets higher here. The NASDAQ 100 yesterday, as you can see, opened up below that 465 support level, but managed to close the day back above that level here, on relatively high volume. That is a fairly strong signal for a potential bounce here. It's hard to say as far as how much will bounce, but that is, I would say, going to be likely news driven here. IWM, same thing, opened up near that bottom at the end of the day. We opened up towards the upper end of that trading range on some decent volume, and RSP equal weight S&P 500 holding that 172 support level here. So we haven't invalidated those major support levels that would suggest that we were headed significantly further lower here. Price action yesterday was fairly positive here, and we'll have to see if the news here tomorrow can sustain that in terms of further upside, or there's going to be some downside risks in terms of, but at the moment, I think the markets are expecting sort of the worst, and we could find ourselves pleasantly surprised as far as what the news is for tomorrow. So pay attention to in markets tomorrow. Chances are we could see some volatility here. Value continues to outperform growth. We have seen commodities continue to rally here on the back of gold reaching new all-time highs and oil also continuing to lift off those lows. High yield corporate bonds so far, holding a more neutral state here at the moment, so not a risk-off environment from the credit side of the bond market here. Not as concerned about the relatively high amount of consumer and corporate debt that's being carried around here right now. So bond markets at the moment not necessarily signaling a lot of concern. The VIX, traded all the way up to that 25 level here at the near the open yesterday. By the time we close, we're back down to around 22% here. So still expecting a fairly volatile month ahead. But overall, we've seen that fear retreat quite a bit here over the last couple of days. 10-year yields continue to decline. This is, I would say, more so on the back of what is a worsening economic conditions or economic data that's coming out that's suggesting that consumers are far more sour in terms of their outlook for the next 12 months. That is likely going to translate into lower consumer spending across the board, which is the primary driver of the US economy. That is still, in my opinion, the biggest risk to the overall equity markets. If consumer spending continues to decline, if we continue to see this particular earnings season, which we're just about to kick off again, where companies provide guidance that's weaker than expected for 2025, that could very much be the catalyst over the next quarter that drives the markets lower. But the bond markets are already pricing in a slowdown in terms of that economic data. It's shifting its expectations for rate cuts in 2025 to match the decline in economic activity. And that's why we've recently seen that decline in the 10-year yield, which lower yields will be generally more supportive here for equities. At the moment, you've got this rally here on treasuries. So we've got this nice rally on treasuries from that $84 low. We've been trading kind of consolidating for a little bit here. It's trading sideways a little bit here to the downside, typically known as a flag pattern in technical analysis, which would certainly target kind of in the $96, $97 range here to the upside if we do break out here. So Treasury is on the verge of what looks like could be a potential move here higher, while the dollar at the moment kind of stalling around this 104.50 level here is at risk of pulling back a little bit further as yields continue to decline. Bitcoin continues to underperform here. The 50-day moving average continues to slope down. There's, in my opinion, still some downside risks here right now for Bitcoin. Gold reached our $3,100 upside target here. We'll have to reevaluate it in terms of what our upside target from here is in terms of gold, but the primary driving factors that have driven gold to this all-time high remains in place. So our expectations are for gold to continue to grind higher here. Historically speaking, gold, when on a rally like this, does tend to experience fairly quick and violent sell-offs. So that is one thing that you need to be considerate of if you are buying gold or buying GLD or buying mining stocks, is that volatility that does tend to come into the gold markets when it has extended rallies like we've seen here in gold over the past few months. So that is something that for options traders, you can potentially harness that volatility, but for traders who are buying that upside exposure, it's important to understand kind of the nature of how volatile gold can be at times during strong rallies. The big move here in oil is really what's contributing to the strength we've seen in commodities in addition to gold reaching new all-time highs. But overall, commodities continues to outperform here versus the equity markets. Now, if you look at the sector rotation, this is really where we continue to see a fair amount of lack of rotation. Essentially, what we see here is over the past few months, technology has continued to underperform the S&P 500 by a pretty wide margin since the start of 2025. Consumer discretionary also underperforming the S&P 500 by a pretty wide margin since 2025. Note that consumer discretionary has in the short run kind of found a little bit of support here. So we'll see if this can maybe provide a bit of a bounce here, but I don't particularly have a lot of confidence that we'll see much of a bounce here in consumer discretionary, that it's more likely that bounces will be more opportunities to add some bearish exposure, especially in some specific, retailing stocks, communications, which has been a very strong sector here over the last month or so, last 2 months, have started to, just perform. It hasn't really outperformed the S&P 500, but financials actually continues to outperform the S&P 500 here at the moment. Consumer staples outperforming the S&P 500, healthcare outperforming the S&P 500. So we're seeing rotation out of tech, out of consumer discretionary into all of these more defensive sectors like staples, healthcare, utilities, even real estate. Look at real estate as we're starting to see some outperformance in real estate as yields continue to decline. Energy outperforming the S&P 500 as oil kind of lifts off those 52-week lows. Utilities outperforming the S&P 500 by a very wide margin here since the start of 2025. So that more defensive nature of utilities really providing kind of a shelter against the downside that we're seeing here in equities, which, is part of the picture as to whether or not our view is that there's going to be significant downside risks here in the overall markets. The fact that the more defensive sectors have held in there leads me to believe that the downside risks in equities at the moment is still somewhat limited. As we hold these major support levels over the last couple of days, could be a potential short-term buying opportunity here. If we were seeing selling across all of the sectors, that would be a different story, but we're not seeing that. We're seeing kind of the sell-offs in some of the growth sectors, but even within and that flow is not only going into the more defensive sectors, but we are still seeing some of the more cyclical sectors like industrials and materials manage to hold in there. So it's not like this broad sell-off that we're seeing across all sectors, across all slices of the market. It's really only in predominantly the growth sectors at the moment. So that can change. It's really important to understand that. But in the short run, the flow here in terms of equities is not particularly bearish, and actually in the short run could potentially be a little bit of a buying opportunity here right now, given what we're seeing here across the sectors. Home builders continues to underperform. Semiconductors continues to underperform. That's definitely one of the sectors that I think for a lot of investors, if you have exposure here in semiconductors, it's important to be aware of that and consider that as you're considering kind of where the buying the dip opportunities are, and understand which sectors to trade in, which sectors to potentially avoid. With that, let's take a look at some of our ideas here for today. Just give me 1 second to pull that up. So when we look at kind of ideas here right now, it's a combination of looking at some bearish opportunities to some bullish opportunities here right now. So, within the consumer discretionary space, one of the ones that I think is worth paying attention to here is Amazon. We've seen Amazon, trade lower here, rally, but then continue to move lower from here. There's a risk that Amazon pulls back further, because as a kind of a retailing stock, it trades at a very heavy premium relative to its peers, trading about 30 times forward earnings, versus its peers are trading closer around 17, 18 at the moment. Amazon's net margins are actually lower than the industry. Net margins are only around 9%. Yes, AWS is hugely profitable, but AWS ultimately is still not the majority of the income for Amazon. So if you look at the net margins across the entire business, you're only looking at about 9%. That means for every $1 they generate in revenue, they only turn about 9 cents of net profit on that $1 in revenue. And with that kind of relatively thinner margins, trading at 30 times forward earnings, it's a difficult valuation to sustain if growth is starting to slow down. That's exactly what we're seeing, across the board, including Amazon. So for those reasons, this is definitely one of the stocks that we're paying attention to here right now as a concern for some particular slowdowns. We also have stocks like JP Morgan. JP Morgan, keep a close eye on this, but we're starting to see what looks like a bit of a head and shoulders pattern emerge in JP Morgan, and it trades at around 2.1, 2.2 times book value, which is significantly higher than its peers. Even though it's expected to grow a little bit faster than its peers and net margins are slightly ahead of the industry, the fact that it trades at a valuation that's about 50% higher than most of its peers suggests that there's a significant amount of downside risks with JP Morgan, which ultimately still has a fairly large exposure to the consumer market in terms of their products. Their M&A division is could be a department that does come in and perhaps saves the day a little bit in terms of the next earnings cycle. But this is one where we really have to pay attention to guidance very closely here. JP Morgan really helps set the tone for the entire earnings season and many times the year in terms of the guidance that they put out, what they expect consumers to do, what they expect the bank to do. It sets the tone a lot for the entire earnings season. So we'll be paying attention to that very closely here in the next couple of weeks as JP Morgan reports. But the head and shoulders pattern is concerning that we could get a pullback here into that 225, 220 level. And if we break below that, that really starts to open some downside. So that's one that we really have to pay attention to here right now. Now, one trade that I do think is worth paying attention to right now is Ford. Now, Ford is at the center of the tariff trade war that the U.S. is sort of venturing in. Now, I would say out of the auto manufacturers, Tesla is by far the manufacturer that's least affected by the tariffs, meaning they produce a relatively high percentage of their cars within the U.S. And Ford is second. They do have some popular models that they import over from Mexico. It's not 100% clear just yet as far as what the tariff situation will be like for countries like Mexico with regards to cars. But Ford is relatively safer compared to other car manufacturers that largely import cars here into the US. So Ford could see a bit of a bump here on Wednesday when the tariffs come through and we get a better read as to how affected will Ford be. So if we do see a more positive note, a more lenient approach to tariffs, Ford could potentially be one of the stocks that benefit from that. Not to mention, auto sales in the month of March hit a record because consumers have been anticipating the tariffs coming into play in April and have been buying vehicles at record pace. So we do expect Q1 to be a relatively strong earnings quarter for car manufacturers like Ford, and that could, in the short run, provide a bit of a temporary bump here as well. So Ford, trading at a pretty heavy discount, around 7 times forward earnings versus the 10 times that the industry, commands, and then it grows faster than the industry and is slightly more profitable than the industry. So the fact that it trades at about a 25% discount to the rest of the industry represents, some of the upside value that I see here for Ford. Another one that I think is worth paying attention to is NextEra Energy. This is obviously a stock that has underperformed here towards the end of last year, but this year it's really kind of started to stabilize and start to form a bit of a bottom here. It hasn't quite broken out yet to the upside, But as you can see, not only has it bottomed, but it started to outperform the S&P 500, and that's a really good sign that we like to see going into a sector that's starting to see some outperformance here. Nextera Energy, certainly at the forefront of utilities that have to build out power infrastructure for data centers. Expectations here for investment into AI focused data centers in 2025 and 2026 remain incredibly robust. And there is still at the moment at least a few $100 billion expected to be poured into that type of infrastructure spend. And one of the key components of building out those data centers is the power generation that's required to power those. And utilities like Nextera Energy gain to benefit from that. So that's part of why this is one of the stocks that we really like here at the moment. Now, all of the Chinese tech stocks, I've talked about this over the last couple of weeks, remain on our radar here. This is Alibaba on a weekly chart here. If you look at this weekly chart, Alibaba, as you can see over the past 3 years, have kind of formed this major bottoming formation here between 70 and 120. It just broke out here a few weeks ago when we started talking about this. It's been consolidating since that breakout here, and I think we're potentially on the verge of potentially seeing another breakout here to the upside. So Baidu trading at a very significant discount to the industry. It's not expected to grow that much here, but net margins exceed the industry by a pretty significant margin, which justifies a much higher valuation that it's trading at versus the roughly 9.5, 10 times forward earnings that it currently trades at right now. And obviously, if you were looking for investments within AI, China really represents at the moment the most the cheapest valuation that you can buy when regards to exposure to AI. And Baidu, with their Ernie bot and Ernie chatbot, is sort of the equivalent of ChatGPT or Google Gemini here of China. So certainly at the forefront of AI innovation here within China. Newmont Mining, with gold continuing to reach all-time highs. Newmont Mining on the verge of potentially a breakout here of this double top around 48. That would target our upside target around 57 or so. Newmont Mining also trading at a discount relative to its industry average despite faster than expected growth and net margins that exceed the industry. So, a few of the gold miners, whether you want to get exposure through GDX, the gold mining ETF, the GDXJ, which is the junior gold miners, those are smaller cap names. The smaller the market cap on these gold miners, the more leveraged typically those names are. And leverage simply means that you get more exposure, if you will, or more magnified exposure here to the swings in gold and silver. But overall, Newmont Mining, the second largest gold miner behind Barrick Gold. So on the bigger end of the spectrum in regards to market cap for gold mining stocks. Amgen, within the healthcare stock, this is one that we particularly like. It's outperformed the S&P 500 by a pretty wide margin here. We started talking about this stock when it broke out from 280. So ever since it broke out from 280, it reached all the way up to 305, came back to retest it, broke out above 305, traded all the way up to 335, and now we're back to 305 to retest that support. So we're looking for another bounce off of that 305 level here, back towards that 335. Amgen, right at the moment, trading at a slight premium relative to the industry. So that's one that we just have to be cognizant of in terms of valuations. It's by no means excessive valuation, but it is now. When we entered this trade, it was below industry average valuation, but with the recent run, it's now trading at what I would say more closer to fair value. That doesn't mean there's an upside in there, but just perhaps a little less upside than where we were when it was trading around 280. So I continue to be concerned about Apple here. We've traded up into that 225 range. The fact that it trades at 30 times forward earnings is really just the more ridiculous nature of Apple. Um, you know, the it's just not the company it used to be from its ability to generate sales and earnings. We've seen sales decline multiple months now with regards to the iPhone 16 as they have seemingly completely fumbled the launch of Apple Intelligence or their AI features. We were meant to start to see some of those features last year, and we were meant to see the rest of all of the features that they marketed the iPhone 16 with in the spring of 2025. And at the moment, it doesn't look like any of those types of major AI related features will be making it into any type of iPhone until next year. And what that means is that the iPhone 17 upgrade cycle is now at risk of effectively being shipped without the Apple Intelligence features that Apple's been promoting over the last 6 to 8 months. So when you combine that with the fact that um, Apple has staked their entire future on augmented reality with the Vision Pro, and we're currently in a market environment where um, Meta and Snapchat are arguably in the lead with regards to both software and hardware in terms of commercialization for augmented reality. So for those reasons, I think Apple is quite vulnerable where we are. It's still trading at a valuation that just does not make sense for the business here at the moment, trading at 30 times forward earnings when growth is expecting to slow down to around 10% EPS growth. Revenue growth is meant to slow down around 6%, revenue growth. Net margins are still hanging in there around 24%, and you should see a premium in terms of valuations because of its higher profit margin. But as growth continues to slow down, that profit margin is likely going to get squeezed. And I think there's some significant downside risk that remains in names like Apple. I happen to like stocks like Nvidia and Meta and Alphabet far more than I do the Apples of the world here at the moment. So that kind of gives you a fairly comprehensive view here of the broader markets, some of the trade ideas that we have here for the week, both bullish and bearish ideas. Tomorrow is going to be a big day with regards to tariffs, so make sure that you stay nimble. Make sure you stay close to kind of to the news, so that you better understand and digest what type of tariffs will be put in place tomorrow, and that could very much be a major catalyst here for the markets. So pay attention, and we'll be back here next week to update you on everything. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.